Most traders chase the thrill of making money, but they end up not making any money. They want to win, but they're not willing to put in the work to win. Let me explain. The majority coming into trading want their fair share of the profit, and they want it now. They want the Lamborghini, they want the Porsche, but they're not willing to put in the time to get to the Porsche and the Lamborghini, which is funny. Sadly, losers that come into trading adopt the bad behavior of 90% of the people, because the people that got the people inside were probably just advertising and not really providing value how to make money. And then people just copy the behavior and end up being a loser and blaming Trump, blaming the 10 gods, and thinking, it's not my mistake, the game is rigged, it's unfair, it's impossible to make money with trading. But there still are the other 10% which make money. Here's the funny thing. Winning in trading is actually super boring. It's essentially doing the same work over and over again. It's logging trades, it's reviewing, it's backtesting. It's the boring work. This is where the success is coming from. But you cannot do marketing about boring work. You cannot do marketing about hours of just backtesting, not making any money. So therefore, the 90% of people are being advertised by the people that say you can make quickly money. So they set the wrong expectations, which is a shitty part of the community of trading in crypto, whatever. But yeah, so here is the work essentially that I want to share with you guys today, which is day 37 on Project 100, which is called My Philosophy, because I'm going to be showing you guys behind the scenes on how I'm doing everything, and more specifically, why I'm doing specific things. So the work that I define for myself important, or it's basically based on one of the top-notch GOAT investors of all the time, which is based on Charlie Munger. And the base analogy or the base idea is inversion. So basically the reason for that approach is that we as human beings, evolutionary, we are not meant to thrive, we're more meant to survive. So this essentially means that we're calibrated not for success, but detecting problems. So what we can do in trading with inversion to get to the successful part is looking at what do the 90% of people that lose do and just inverting the behavior. So today essentially will be this. It will be telling you guys the top 5 reasons why the people actually lose money, and we're going to invert them, and I'm going to show with you guys how I actually use them in day-to-day with my approach towards trading. So essentially the first one is the lack of defined strategy. If we invert that, it's clearly defined strategy. So most traders fail not because they don't know anything about the markets, they don't know why people buy, why they sell. They fail because they're not clearly defined what their approach is. They don't know exactly what their strategy is. They're just getting into the car without any instructions and they just try to drive. What happens essentially through trial and error, they find something, but mostly finding this something is based on emotions and feelings and not based on data. So they don't have a rule set, a checklist, a behavior checklist, and a trading guideline strategy on what they have to do, and then looking for those specific trades. Let me actually show you exactly how I do that. Okay, so to make it essentially very brief, what I'm going to show you guys is how I define my strategy. I have a clear procedure, a rule adherence, a checklist that I have predefined when to enter a trade and when to enter a trade. If we, for instance, go into taking a trade, what is being popped at as first will be a setup checklist. The setup checklist is giving me essentially the guidelines and the things that I have to do to enter a trade, such as for my current strategy is a 0.75 fib extension. It has to be an explosive move with volume stepping in. It must be close, not more than 1 fib level to support resistance, 4 hours daily and weekly. And as you guys can see here, everything that I have defined is very binary. It can be very clearly said yes or no. It's not maybe, it's not discretionary open. Just because I'm a beginner, it's better to act on checklists that are binary, yes or no, because then you actually have data that doesn't rely on your discretion, but it actually relies on proven rules you have set out. If over 100 trades, let's say even 30 trades, you're not profitable, it doesn't mean you suck ass. If you actually followed the strategy and the rule set, it means your rule set sucks ass. So what you can do then is you can go over and analyze with your discretion over and over again why the rules may not be the best. And then with building information on that, you can find out what works best. This is essentially how I'm looking to define my trading system and not lack a defined trading system, which is one of the biggest parts, maybe the biggest part of why people in trading do not succeed. Let's continue with the second part. Second one is one of the biggest, which is the risk management. Biggest in the sense it's the second one. In my opinion, the first one is to actually know what you're doing. It's a strategy. The second one is risk management. This is following the major rule from Warren Buffett, which is never lose money. And the second rule is never forget first rule. So this basically, and I will show you guys in a second, a very cool tool how to calculate that. This is essentially how to protect your money. There is something called risk of ruin, which I'm going to get into in a second, but there is possibility, there's really possibility, and we see that multiple times, on how you can lose all of your money. But there is also possibility on really minimizing your losing and maximizing your profit. How you do that is essentially by knowing exactly how much you risk per trade strategy, per trading strategy. This depends on the win rate, this depends on the risk reward, how much you make, how often you win, things like that. It's essentially the mathematical part of trading, but probably one of the most important one, because with this you can lose all your money, and if you lose all your money, you cannot trade anymore and you can go work at McDonald's. So you don't go broke by not winning enough. You go broke by losing over and over again without knowing how much you should risk for a specific thing. Typically, as a rule of thumb, 1% to 2% I risk of on my capital, and as you guys know, I don't really know a lot of things, so I'm still at the beginning stages. This is just a rule set based on what mentors say and things like that. Currently, I risk 0.2% to have skin involved into the game, but not be overly exposed into the game. So yeah, currently 1 to 2%. I will give you guys a calculation on why 1 to 2%, which has to do something with the risk of ruin. So yeah, the base idea behind trading and know how much to risk is to know how much to risk to let your edge play out over time through your strategy so you can survive. This is essentially, it's an infinite game perspective. The game of trading will never end, so it plays infinitely. It's about surviving, not reaching a specific goal, if that makes sense. And additionally, you want to be profitable. So yeah, the less you risk, the more you protect your capital, but you also limit your potential upside. There is a fine balance, which is usually at around 1 to 2%. And I'm going to explain you guys why this is exactly. Yeah, let's get into it immediately. Okay, so here we go. Here's essentially the idea behind risk of ruin. To make it easy to understand, risk of ruin means, let's say you have a bank account, and out of the bank account, you have a potential probability of losing all of your money. This could be in real life by somebody stealing it. There is a percentage for that, which is, let's just guess, 1 out of 1 million times this happened. There is the risk of ruin of the bank, which is there is a probability that the bank just goes bankrupt and cannot provide the funds for you. We have seen that in crypto with FTX. Some people got their money back, but it took years. So you also have probability of losing money by just your payment provider or your bank provider or your fund provider. Yeah. So inherently, whatever we do, there are risks. Just usually with the finance world, they're a little bit lower, and with trading, we actively lose money by taking trades, or we actively make and lose money. It's a balance between both. So there is actually real opportunity to lose money. Let's just say you have a strategy which never wins. Let's just take this as an extreme. You have $1,000 per trade, you risk $100. After 10 trades, there is a 100% probability that you lose everything. Let's say the win rate is 0%, which is a calculator for risk of ruin. Average win is 0 because we never win. Average loss is $100. The risk per trade is 10% because we have a total capital of 10,000 in this, or 1,000 in this case. And loss level is 100%, so we want to lose all the money. Number of trades, how much trades does it take to get to risk of ruin? You see, infinitely number, like you will definitely lose your money. Let's say now all of a sudden when you take a trade, you win 50% of the time, and when you win, you make $20, and when you lose, you lose $10, which is a very good, healthy risk reward to win rate ratio for trading. You're a profitable trader at that point, and you see when you calculate that, the risk of ruin is only 1.59%. As you can see, there is still potential over 100 trades that you lose all of your money. There is potential, which is very minimal, 1.59%, which has to do something with how much do you lose per trade. This is a 10% risk, but this is considering a 50% win rate, which is usually pretty high. Taking it to the other extreme, if we say, for instance, we never lose, what is the risk of ruin going to be then? 0%. Makes sense how the tool works? I'm guessing so. So how we get to something like 1 to 2% is by minimizing the risk of ruin close to 0, but maximizing profitability. So let's just say our risk reward ratio is 2, or let's say 2.5, or let's say 2.5, which is $25. Let's say we only win 30% of the time. So we take 10 trades, only three of them we're going to win, 7 we're going to lose. The average loss, we lose 10. If we win, we make 25. And let's say we risk 10%. Calculate, 67% of the time we're going to lose money. Or we're going to lose everything. We're going to lose all of our money or total balance, independent of how big this is. If we essentially, with a winner of 30, only have a 2.5% risk reward ratio and we risk 10%, we lose all of our money. Taking an average risk reward ratio with an average win rate, let's say, which would be, I would guess, 50%, and risk reward ratio of 1.5. So we win $15 if we win, and we lose $10 if we lose, and 50% of the time, which is a profitable part. My father's calling me. I'm going to not accept that. With 10% risk reward, or 10% risking per trade, we're going to lose 4% of the time, which is incredibly high. But if you reduce the risk to 5%, all of a sudden you go to almost close to 0%, which is just halving your risk. You almost completely annihilate all the risk of ruin. So there is very, very low probability, close to 0, of losing all your money. So this is why risk management is so important, because you can, with mathematics, find out for your trading strategy, what is the potential for me to lose all of my money. This hopefully goes to show the importance of risk-reward ratio, and a very easy and quick way for you guys, maybe you didn't know it, to calculate how much you risk is with TradingView. You have the short and long tool, which are those two tools. For longs, this one; for short, this one. And you have the ability to choose how much you risk right here. So currently I risk 0.2%. I could use 1%. And let's say I get into the position right now. I will put stop loss under this low here, and then I target something like those highs. It tells me exactly how much of Bitcoin Cash I have to buy, which is 5.427%, to put my stop loss here and only lose 0.2% risk. Vice versa for shorts. Very easy, very quick way to actually find a way of putting in your risk, which is super cool. I hope that helped. Okay, so this essentially showed you guys exactly at the background what is going on, what I'm doing specifically to incorporate. Goes way deeper than that, obviously, but this is a little bit of a glimpse for you guys to understand how I actually keep track of my strategy, why it's clearly defined, and also in addition to that, why risk management is so important. You could do hour-longs of videos for this, but this just goes a little bit to the surface on why we actually use those things and why specifically the traders that don't make money are not using those things. So as the third one, I think one of the biggest one as well is because this can also can destroy you within one day, is if you have no emotional resilience and basically no control over your emotional impulsive decisions. So inverting this is essentially making data-driven and disciplined decisions. How we do that is like the tools I just showed you with like Edgewonk, where you track everything to the T. Did I follow my rules? Checklist. Which rules maybe did I not follow? How was I before my entry? How was I during my trade management? How was it during my exit? Did I anywhere violate my rules? You can track that. You can track that with Google Sheet. You can track that with just a pen of paper, and just like, important is to have it simple, and important is to be consistently over time tracking your things, so you can create some perspective on your behavior and say, am I actively really trading, actually really trading emotionally, data driven, or am I maybe in the boat of people that trades emotionally impulsive decision? It doesn't have to be that some of you traders that maybe are not profitable, that you do everything wrong, but maybe there is something that is just completely killing you. It might just be the impulsive part. The thing is that emotional decisions feel good in the moment, because some of us still in us kind of have the decision or the definition of success as I want the money. So when you take the trade, it's the closest thing, it's the closest correlation to your success, because this actually gets you to the success logistically. But in fact, this is not where the actual money is made. Theoretically, yes, and practically as well. But the real reason is you building a strategy, sticking to the strategy, and over time with consistently implementing that rule set, making money just based on data. So it feels good to take trades. It feels good. It feels liberating. It feels like, oh my God, I'm progressing. I'm maybe getting closer. Maybe this trade will get me an iPhone. Maybe this trade will get me whatever the price is for you. But then you're trading literally like the 90% of people. And how can you think in that instance? How does anybody with 2 brain cells think that I will make money thinking like everybody else? That's selfish. Not only selfish, it's just completely ludicrous and stupid. And I think this is the reason why trading is funded by those types of people, because they don't want to change. They don't want to take on the responsibility on them. They want to blame Trump. They want to blame the economy. They want to blame everybody else but themselves to progress. But this is essentially giving the people that want to take on responsibility the clue, okay, I actually just have to manage my data, and I have to have a disciplined decision making. I know, guys, the scribble that I'm doing here is definitely not readable, but it's more for just for the sake of writing something on the whiteboard. There is some specific energy to that. So the fourth one is the lack of patience and inconsistency, or rather over trading, lack of patience. You want which is kind of like tying into the third one. It essentially means that you think you can get to the result quicker than everybody else. You have the expectation in your head, hey, I could theoretically, which is true, you could theoretically click a button and have a Lamborghini. I could make it tomorrow. So you massively overtrade, and what happens with the risk of ruin I just showed to you guys, with this, you just massively increase probability of losing all of your money. What we want to do as profitable traders, find something that works, then reducing as much as possible the risk of ruining, the probability of losing all your money, which is, as Warren Buffett said, like, if you don't trust me, just trust him. The most important thing is don't lose your money. So essentially, the overtrading is death by 1,000 cuts. It's over and over again, losing a trade. Oh, I need to get the money back because it feels like a loss. Evolutionary, if we lose resources, it feels like we have to get them back. In trading, this is counterintuitive, because all of the monkeys going in there and losing money go in with the psychology. And as we know, as inverted thinking, like Charlie Munger told us, we just have to flip that idea. So when everybody goes in to trade again, we don't, because we don't trade based on emotions and out of lack. We trade out of strategy, data, mathematics. So we trade very specifically, very patiently, and selectively. This is, I definitely believe, or at least I've seen proof for that for myself, that I cannot be patient just by thinking I'm going to be patient. I cannot be selective by thinking what do I have to do? That's the most important thing. What it comes down to at the end of the day is, what do I have to do to be a person that is patient? It comes down to the behaviors. So what you have to do is essentially find out something in the opposite, or what do patient people do? They, before they enter a trade, breathe, look at the checklist. Does this follow my checklist, yes or no? And then they decide if they enter. They don't just enter because I think this will go up. Oh, I will put the stop loss there because I think it will go down. They don't think, they act out of checklists. So that's a very key one, especially for the beginners under us, which maybe if you're losing, you probably are a beginner, and there is nothing to be blamed for that. Everybody has to start somewhere. Everybody will lose money. Everybody that became a millionaire with trading lost money along their way. Anybody that tells you it's not the case, probably you shouldn't listen to them. They're setting up wrong expectations. And for me, I don't want to just win the lottery. I want to earn it to build the character trait on the meantime. The fifth one is failure to adapt to market conditions. Failure to adapt. So what we do is we adapt to market conditions. And just because I didn't really get into this, how you can actively do that operationally, you do that by going back into the third rule in the first one, which is having a clear checklist what you have to follow, and having rules for maximum trades. So if your problem is over trading, for max trades. If your problem is over trading, it means if you get a trade, you lose it, you want to get another trade. So maybe you could set up a rule for your checklist to say, if I lose a trade, for the next 2 hours, I will not trade. This is the perfect environment you can set, the perfect condition you can set for yourself to not overtrade. So you just set the conditions and environment around you to reinforce the specific behavior, which is part of the behavior of somebody that is patient and selective. So I'm only going to trade when the 1 hour has passed. If I lose 5 trades in a week, I'm not going to trade at all. I'm just going to be reviewing. Rules like that set you the guardrails not to only not lose your money, but also over time become a patient person. The fifth one, how we can adapt to the market conditions. This is also the importance of tracking, highlighted by. So if you track, if you don't trade out of your discretion, out of you think, I think it will go up, so let me buy. If you trade out of data and proven things you have put into your journal, you will see, oh, the last 3 weeks were good, I was making money. The last week was wrong, but I was following my rules. This makes you think, this raises a question mark. So question comes out of the data. This raises your awareness of what actually is going on, and what you do there is not just wander around, think like, oh, I'm a bad trader, or the market condition. You go back into the data and look, okay, what market are we even in? Maybe you can cross-check that with other data and say, oh, we're currently in a raging market. Probably trend trades don't really make a lot of sense. So I should be taking trades that are for ranging markets. So what you can do there is you don't just jump into a new strategy. You only just select the new strategies you have already proven you're profitable in before you put money inside. So what you can do is you can either start backtesting ranging markets and starting learning a new strategy within, testing it with data, and then over time slowly increasing your risk tolerance and not blowing up the profits you have made with a proven strategy before when you adapt a new one. So you take your time with a new one, you slowly increase the risk, or you maybe even start with backtesting, and over time you add risk and risk and risk. The more confident you become and the more win rate you get with your own strategy. So those are just some key ideas how my whole philosophy around my decisions currently are, why I also want to join the course or the mentorship of Karush, because it goes deeper into those specific notions, and I think this will be a massive opportunity for me to learn even deeper, specifically from a neutral perspective like Karush, that can tell me, hey, you're wrong here. Like, we've seen it with other people, this pattern doesn't work. And this doesn't require me years or months or weeks of going in there and trying to understand it by myself, but somebody can just pinpoint it, like, I've done the same mistake, don't do it. And this is the easiest shortcut you can get to success quicker, let's say. And yeah, that's have been essentially a little outlook or a little insight into my why I do specific things with my strategy. Just the idea shared from Charlie Munger, inversion translated into trading, and how maybe you guys can implement that. Maybe you see yourself in some patterns losers do, that you can just get rid of and not do anymore going on forward, and rather implement the inversion and do the opposite of what 90% of people do and make money. Wish you guys all the best with trading. As of Project 100, I've taken one trade. Maybe I can post a screenshot right now. It ran pretty nicely. It was a Bitcoin Cash short, but that has been the only trade I've taken so far. It's still pretty hard finding some trades in these market conditions. I'm very, very aware right now what trades I take, just because I kind of also have some expectations for myself to have good trades before I get into the course, into the mentorship of Karuj, which starts in 2 weeks. They will require myself at the beginning to assess the first 5 trades, so they can look at who I am, what I do, just with the pattern of 5 trades. I want to come in with a lot of data. I want to come in with clear information about how I trade. So I will be very particular about my trading style, very particular about my checklist, so they know what I'm following and can immediately go into helping me with the real issues. So that has been for the day 37 as a 27-year-old today. Wish you guys all the best. I hope you're killing it in the markets, and I hope you're making progress in your own endeavors. It's a tough journey. With some people together, it's a little bit easier. So I hope I can create a community here over time. And more importantly, I want to journal this for myself, just to look back at that one day and laugh at it. But yeah, if you guys could take something out of that, wish you all the best. Cheers.